Have you ever felt invisible? Not unseen, but unseen by the systems that decide whether you get a chance. Imagine building a life, working hard, finally securing a good job, a safe haven for your child, only to be told no before you even begin. Not because of who you are, but because of a number. A number you didn't even know you needed. That number is your credit score. And for 45 million Americans, that number simply doesn't exist. It's a quiet barrier, a digital gatekeeper, standing between people and the basics of modern life. An apartment, a car, even a job. A woman in San Francisco, back in 2017, a single mother with a steady income, found herself locked out. She had the money for a down payment, the rent, proof of stable employment. Everything seemed right. But the answer was always the same. Without a credit score, we can't even consider your application. It feels unfair, doesn't it? Like an invisible wall erected before the race even starts. We're told credit scores were meant to democratize lending, to remove bias, to let algorithms make objective decisions. But somewhere along the way, they've become essential. A requirement for participation. And lacking one or having a flawed one can feel like a life sentenced to financial limitation. But how did we get here? What exactly is a credit score, and why does it hold so much power over our lives? It begins with a report, a detailed record, a digital dossier compiled from pieces of your financial life. Your zip code, your employment history, your debts, or more accurately, some of your debts. Because here's the crucial point. Only information from major lending institutions makes its way onto these reports. Think about it. You diligently pay your cell phone bill every month. You consistently cover your rent. Responsible habits, right? But those payments, they're largely invisible to the credit reporting agencies. It's as if only certain financial interactions count. There are three major agencies, Experian, Equifax, and TransUnion, each maintaining its own version of your financial history. Millions of data points flowing in from credit card companies, student loan servicers, lenders, a constant stream of information that shapes your score. Then come the scoring companies, FICO and VantageScore, taking that data and running it through complex algorithms. These algorithms churn out a number, a 3-digit representation of your creditworthiness, ranging from 300 to 850. Higher number means lower risk and often better deals. The irony. Even though they draw from the same data sources, these scoring models don't always agree. One might prioritize the length of your credit history, rewarding longevity. Another might focus on the variety of your accounts, appreciating diversification. Still others might emphasize payment history or credit utilization. The scoring companies profit from this system, selling your score, your data, to landlords, lenders, employers, anyone willing to pay for it. Lenders use it to assess risk, to determine whether to approve a loan and at what interest rate. A low score can mean being denied credit altogether or being saddled with exorbitant fees. You could be deemed risky and pay hundreds, even thousands, more over the life of a loan simply because of a number. But the story doesn't end there. There's a hidden history embedded within that score, a legacy of systemic inequalities that continues to shape financial outcomes today. It's a history that goes far beyond simply paying your bills on time. Let's rewind. For most of American history, creditworthiness wasn't about algorithms. It was about character. It was about trust, built on personal relationships. Within a community, a dressmaker in Boston could rely on a local store for fabric, knowing the storekeeper trusted her to pay. That trust extended back through a network of suppliers, even to a cotton planter in Georgia. But that system wasn't equitable. It was built on the backs of those whose labor was never acknowledged, and whose own access to credit was systematically denied. Enslaved people, exploited workers, they were integral to the economic engine, yet excluded from the benefits of the system. After the Civil War, as people became more mobile and business relationships stretched across greater distances, this interpersonal system began to crumble. The need for a more standardized way to assess risk emerged. In the 1870s, handwritten credit reports began to appear. Detailed assessments of merchants like R.H. Macy, tracking their payment habits and overall reliability. Soon, retailers started sharing information about their customers, creating networks of credit knowledge. But this early system was far from neutral. By the 1950s, credit reports included invasive and discriminatory information. Investigators were instructed to assess a borrower's morals, their habits, even their sexual orientation. Women faced barriers too, obtaining credit in their own names, and minorities were routinely denied access altogether. Banks will not lend money for a Negro to purchase in other than what is termed settled areas, read one policy. A chilling reminder of the overt racism embedded within the financial system. The Equal Credit Opportunity Act of 1974 aimed to address these injustices, prohibiting discrimination based on race, gender, and other protected characteristics. But simply removing these categories from credit reports didn't erase the underlying inequalities. Bias found ways to creep back in. Employment history, a seemingly objective data point, could inadvertently reflect racial disparities. A black worker might be more likely to experience job loss during an economic downturn, leaving a mark on their credit report that had nothing to do with their financial responsibility. Neighborhoods historically denied investment would see lower property values, impacting a homeowner's creditworthiness, regardless of their payment history. Imagine a grandfather returning from the Korean War, denied the same affordable mortgage opportunities as his white counterparts. His children benefit from the wealth accumulated through that mortgage. And then his children benefit, creating a cycle of advantage and disadvantage that spans generations. The echoes of past injustices reverberate through the credit system today. It's a system that perpetuates existing inequalities, excluding those who have been historically excluded. Today, over half of black adults have a credit score below 650, leading to higher interest rates and limited access to financial products. And credit scores aren't just about loans. More than half of employers now consult credit history when making hiring decisions. A flawed credit score can literally close doors to opportunity. So what can be done? Is this system beyond repair? Some cities and states are beginning to restrict the use of credit scores in non-lending decisions, like housing and employment. Others are exploring alternative credit data, like rent payment history or participation in informal lending circles. These lending circles, rooted in communities and built on trust, are a powerful example. They demonstrate that creditworthiness isn't solely defined by a three-digit number. It's about community, responsibility, and mutual support. Perhaps empowering local credit unions and nonprofits to formalize these circles and report those payments could help build credit for those currently excluded. Startups are also experimenting with alternative scoring models, using data points beyond the traditional credit report. But ultimately, individual fixes aren't enough. If we truly want to level the playing field, we need systemic change. We need to acknowledge the historical injustices embedded within the credit system and address them head-on. Access to credit has become a fundamental requirement for participating in American life. It's the key to unlocking opportunities, building wealth, and achieving financial security. And the system we have today reflects a history where not everyone had access to that key. So the next time you think about a credit score, remember the single mother in San Francisco. Remember the generations of people whose access to financial opportunity was unjustly denied. Remember that a number isn't just a number. It's a reflection of history, a measure of opportunity, and a symbol of a system that needs to be reimagined. It's a system that needs to be fairer, more inclusive, and more reflective of the true character of the people it serves. Because everyone deserves a chance, and everyone deserves to be seen not just by lenders, but by a society that believes in equal opportunity for all.